When it comes to saving or growing your money, most people think of putting it in a savings account at their bank. It's safe, it's familiar, and you can access your money anytime. But there's another option that often gets overlooked: Treasury bonds. If you've ever wondered, should I keep my money in a savings account or buy Treasury bonds? This video will break it all down for you. By the end, you'll understand the differences, the benefits, the drawbacks, and you'll even see real-life examples of how your money could grow in each option. Let's start with savings accounts. A savings account is basically a place to store money at a bank. In exchange, the bank pays you interest. The big advantage of a savings account is that it's extremely safe. Your money is insured by the Federal Deposit Insurance Corporation, or FDIC, up to $250,000 per person per bank. That means even if the bank fails, your money is protected. Another benefit is liquidity. You can deposit or withdraw money whenever you want, which makes savings accounts great for emergency funds or short-term goals. But there are downsides too. The biggest is interest rates. Traditional savings accounts often pay very little, sometimes less than 1% per year. Even high-yield savings accounts today might offer 4 to 5%, which is better, but still relatively modest. Over time, the low interest means your money grows slowly, especially after factoring in inflation. For example, if you deposit $10,000 in a savings account that earns 1% per year, after 10 years, you'll have about $11,046. That's a gain of just over $1,000 in 10 years. Inflation, which averages around 2 to 3% per year, can actually reduce your purchasing power, meaning that $11,046 might buy less in 10 years than it does today. Now, let's turn to Treasury bonds. Treasury bonds, also called T-bonds, are debt securities issued by the U.S. government. When you buy a bond, you are essentially lending money to the government in exchange for periodic interest payments, called coupons, and the return of the bond's face value when it matures. Treasury bonds are considered extremely safe because they are backed by the full faith and credit of the U.S. government. Default risk is very low, making them one of the safest investments in the world. Treasury bonds usually have longer terms, ranging from 10 to 30 years, and they pay fixed interest every 6 months. For example, if you buy a $10,000 Treasury bond with a 4% annual interest rate, you would earn $400 a year or $200 every 6 months until the bond matures. When the bond matures, you also get back your original $10,000. One important thing to note is that unlike savings accounts, your money is generally tied up until the bond matures unless you sell on the secondary market, which can fluctuate in value. So how do Treasury bonds compare to savings accounts in terms of growth? Let's use a real example. Suppose you have $10,000 to invest. You put it in a high-yield savings account that earns 4% per year. After 10 years, you would have about $14,802. If instead you bought a 10-year Treasury bond at the same 4% rate, you would receive $400 per year in interest, totaling $4,000 over 10 years, and then get back your $10,000 at maturity for a total of $14,000. In this simple example, the savings account edges out slightly because of compounding interest paid continuously rather than semi-annual fixed coupons. But if interest rates rise, or if you ladder bonds of different maturities, Treasury bonds can provide more predictable income and a way to lock in a rate, which is particularly valuable in uncertain economic times. Another key difference is liquidity. Savings accounts are flexible. You can withdraw money whenever you need it, making it perfect for emergencies. Treasury bonds, on the other hand, are not as liquid. If you want to sell before maturity, you have to sell it in the bond market, and the price may be higher or lower than what you paid, depending on interest rate changes. This means that while Treasury bonds are safe in terms of default, their market value can fluctuate if sold early. Inflation protection is another factor to consider. Regular savings accounts usually don't beat inflation by much, meaning your money loses purchasing power over time. Treasury bonds can protect you to some extent, and there are even special bonds called Treasury Inflation Protected Securities, or TIPS, which adjust their principal value according to inflation. For example, if you buy a $10,000 TIPS bond and inflation rises 3%, your principal increases to $10,300 and your interest payments rise accordingly. This is something a savings account cannot do. Let's also talk about automatic income versus compounding. Savings accounts often compound interest daily or monthly, meaning you earn interest on your interest. This can accelerate growth slightly over time. Treasury bonds pay fixed interest, so unless you reinvest the coupon payments, the growth is linear rather than compounded. However, many investors choose to reinvest bond coupons into other investments, which can simulate compounding and further increase wealth over time. Now let's consider some real-life scenarios. Suppose Sarah wants a place for her emergency fund. She values liquidity above all else because she might need access to her money at any moment. A savings account is perfect for her. Even if the interest is modest, she can withdraw funds instantly in case of a medical emergency, car repair, or unexpected bill. On the other hand, James is planning for retirement in 10 to 20 years. He wants safety, predictable income, and a way to lock in a fixed return. Treasury bonds make sense for him. He buys a ladder of bonds with different maturities, so every year some bonds mature and he can reinvest or use the income. This strategy gives him predictable cash flow while minimizing risk. So which option grows your money faster? The answer is, it depends on your goals, timeline, and need for liquidity. If you want flexibility and access to cash, a high-yield savings account can be slightly better in the short term, especially if rates are competitive. If you want long-term stability, predictable income, and are willing to lock in your money, Treasury bonds may be better, especially in a rising interest rate environment or if you choose tips for inflation protection. Another consideration is taxation. Interest earned from savings accounts is subject to federal, state, and sometimes local taxes. Treasury bond interest is exempt from state and local taxes, although it is subject to federal taxes. This can make a difference depending on where you live and your overall tax situation. To summarize, savings accounts and treasury bonds both have advantages and drawbacks. Savings accounts offer liquidity, ease of access, and daily compounding, making them ideal for short-term savings or emergency funds. Treasury bonds offer safety backed by the U.S. government, predictable income, long-term grows safely and steadily over time, while giving you peace of mind and control over your financial future.